Welcome to the Cliffwater Direct Lending Index quarterly webinar for 1Q25. My name is Fran Byers, Head of Capital Markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO and CIO at Cliffwater and creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor founded in 2004, and we are active across the alternatives investment spectrum. Steve's going to kick things off with a recap of direct lending return performance in the first quarter of 2025. I will follow with a recap on recent trends within the direct lending market for both the months of April and May, and basically discuss how direct lenders are navigating recent market volatility. And with that, Steve, please start us off.
Thanks, Fran. To remind everybody what our index suite looks like, and we're going to be talking today about the CDLI, the first listing, which is a measure of performance for the broad universe of U.S. middle market loans using information available from BDCs through their SEC filings. But note also that we have three other indices that measure performance of middle market collateral. One is the CDLI-S, senior only, CDLI-V that looks at just venture-backed loans, and CDLI-P, which is a performance for collateral within perpetual BDCs. We also have two indices that measure the performance of managed accounts. We have the CDLI Unlevered Net of Fee Index. So this would be useful for those of you who actually manage accounts, but on an unlevered basis. And then we have the CDLI L for Levered Net of Fee Index. This would represent the majority of managed accounts that are levered, but we show what performance is net of fee. And then a couple quarters ago, we introduced the CDLI upper middle market, UMM upper middle market, and the CDLI LMM lower middle market to note the difference in performance of direct loans in the upper middle market versus the lower middle market. So we have many indices here. We're going to be producing more indices, but our flagship is what we're focusing on today, the CDLI, which is the entire universe of middle market loans. Next slide, Deb. Thank you. So we've tallied the numbers through March 31, 2025. And basically, it's a continuation of a trend that's been going on really for the last 4 to 5 years. Post-COVID, a pretty moderate market where we haven't had much turbulence within the middle market. Obviously, there's been some turbulence outside, but it's been fairly quiet. So for the trailing year, the CDLI has produced a 10.37% return. That's comprised of interest income of 11.47%. And there have been both realized losses and unrealized losses. The realized losses, 63 basis points, which has been, as it has over the last several years, below the long-term average loss rate of 1.01%. So losses have been fairly modest over the last year and the last few years. We also have unrealized losses over the last year of 40 basis points, reflecting some of the turbulence in the market, particularly more recently. Over 5 years, over 10 years, and from inception, the CDLI has produced returns of between 9 and 11%. So as I've said in the past, this is a pretty consistent asset class with low volatility, producing high single-digit, low double-digit returns. That pattern of returns is displayed at the bottom of this slide, where we show quarterly returns through March of this year. Notice that most of these returns are positive and significantly positive, 2 to 3% per quarter. When we get involved in significant turbulence, often associated with recession, we can have a negative quarterly return. The last negative quarterly return was during COVID. Remember the first quarter of COVID, the return on the CDLI was minus 4.84%. We had a couple very almost insignificant negative returns associated with the oil crisis. We had a euro crisis, but those were fairly minor. If you look at the midpoint of this graphic, and then the great financial crisis, where we had losses particularly for the fourth quarter of 2008 of 6.68%. That was the worst quarterly return in the CDLI history. Anyway, this is a very desirable return pattern that which we expect to continue going forward. Thanks, Deb. This slide, we show really the basic economics of return on private debt. Two components, one being interest income, represented by the blue bars, and the second being realized losses, represented by the red line. The return on private debt equals the difference between those bars and that red line. If you notice the blue bars, basically income has been within a tight band over the last 20 years, something between 8% and 12%. Basically, higher levels of interest income during either a crisis or high reference rates, as in the last few years. Lower yields when reference rates are lower and when the markets are relatively calm, so spreads are more narrow. But consistent interest income, that's offset by realized losses in that red line. Those realized losses are less stable, associated with the crisis periods. So if you look at the jump up in loss rates during the financial crisis, the oil crisis, COVID and Russia invasion, basically those deduct from the interest income, and the final return on private debt equals the difference between those blue bars and the red line, as I stated earlier. Of course, this is a representation gross of fee, and it doesn't include leverage, which is often found within managed accounts. Generally, the combination of fees and leverage in most managed accounts under normal conditions add to return, but not always. In the next slide, Deb. Thank you. Just wanted to document the year-by-year history of private debt versus other fixed income indices. So we show calendar year returns from 2005 to 2024, and we highlight the index that had the highest return during each individual year. I'm showing the Cliffwater Direct Lending Index in the second column, followed by two publicly traded credit indices, the High Yield Bond Index and the Morningstar Leveraged Loan Index, the investment grade Bloomberg Aggregate Bond Index, and also showing Treasury bills in the right-hand column, representing cash returns. So basically, as we expect, the direct lending index, middle market private debt has outperformed in virtually all of the individual calendar years. The high yield bond index, largely because it's long duration. Sometimes the long duration is rewarded, and that Bloomberg index gets a kick upward, and it looks to have 1 in 5 out of the 20 individual calendar years. But note that the Morningstar, the equivalent public index, the Morningstar index, has not in any calendar year been the winning index. And then at the bottom, we show the last 5, 10, and 20-year periods. Importantly, through time, the CDLI index has outperformed the Morningstar index pretty consistently by about 4% per year. It's outperformed the high yield bond index by about the same, sometimes let's call it 4 to 5%, and has outperformed investment grade, whether it's the aggregate bond index or T-bills, by a very wide margin, call it 7 to 8%. Next. Thanks, Deb. So importantly, I'd like to just focus in on a few metrics for the index that we look at that measure what I would call overall health of the marketplace. One is liquidity, measured by effective life. This is the average life of the loan within the CDLI. It can go up or down depending upon principal payments, or repayments, and other corporate actions, including refinancing. So the lower the number, the more liquid the index is, and the healthier the marketplace. So basically, the effective maturity of middle market loans, the average is about 3 years. When the market dries up and loans are not repaid, the effective life increases, as it did in the financial crisis. It also did that during COVID quite substantially, up over 5 years, right after the COVID period. It's now down to average life of 3.72 years, still above the long-term average, but very, very close. So basically, from our point of view, the overall liquidity of the market is close to the long-term average. If you turn to the next page, thank you. So we're looking here at non-accruals. These are loans that are not paying. And if you look at the gray area, deep gray area, it measures non-accruals as a percent of cost value or par value. This is at least what I look at as the measure of problems in the overall market. Today, non-accruals stand at 1.3%. Again, if you look at the left-hand axis, it refers to measuring non-accruals. And that 1.3% is well below almost half the long-term historical average of 2.2%. So basically, there are not a lot of problems in the overall market. Part of that may be due to recent growth in the market. It takes a while for non-accruals to appear in a portfolio. But nonetheless, if you buy the market, the number of problems are pretty small, low over 1%, and half the historical rate. We also show in the line the implied recovery rate. Okay, if there is a default or if there is a non-accrual, what's ultimately recovery on a bad loan, so to speak. And it's been hovering at about 50% for a long period of time, and that's approximately where it is today, 50% recovery. And if you look at the right hand axis, that makes sense to me. If you look at recovery rates in levered loans, broadly syndicated levered loans, it's about 60 to 70%. If you look at high yield bonds, which are a little more subordinate, it's more like 40%. So the recovery rate seems to make a lot of sense. And then finally, talk about payment in kind, or PIK. This is appearing all the time in the press. Like there's a big PIK problem within the direct loan market. A lot of people in the business press, they just get their numbers all wrong. Maybe they're just trying to create a problem where there isn't one. But basically, PIK is payment and increasing the principal rather than simply paying cash interest income. So the amount of PIK really has been low. If you look at this graph, it looks like it's increasing, and it has increased over the last 20 years. But part of that is, the growth of the technology sector, which is a very strong sector. But given its growth, often there's an election to switch to PIK when a loan is originated. Call that good PIK as opposed to bad PIK when a company gets in trouble. But anyway, if you look at PIK, went up during COVID for obvious reasons. It's remained a little elevated, but generally it's stuck at around 7% for the market. And what this means is not 7% of the average. Let's say the average yield of right now is low over 10%. Doesn't mean that 7% is PIK. It means 7% of the let's say 10% is PIK, or less than 1%, or 70 basis points. So PIK is very small and pretty much remains steady as part of the direct lending market. So with that, let me turn it to Fran to dive into some of the details. Thanks, Fran.
Great, thank you, Steve. So on our last webinar, which was only a few weeks ago, the broader capital markets were starting to show signs of weakness as the fear of tariffs, recession, and massive uncertainty began to unfold. While it still remains to be seen what the true impact of these tariffs will be and whether more volatility could be on the way, the subsequent rollback of much of the tariff rates did strengthen investor sentiment over the past 2 weeks. Equity, bond, and loan markets rallied back, and conditions in the loan market have demonstrated more stability, at least in the short term. Of course, this renewed stability can quickly revert as more news of tariffs continues to surface just this week in late May. And so it is likely that the theme of volatility is not going away anytime soon. However, what has remained consistent is that through these volatile weeks, direct lenders continue to show their staying power, as they didn't retrench, but rather they stayed active and they continued to find attractive opportunities to deploy into, which again confirms Cliffwater's theme that we've had for many, many years, that direct lending is an all-weather asset class. So flipping to the next slide, we want to start by just recapping the recovery in the broader public loan markets, but again, caveating that the tone can quickly shift again with the news cycle. Chart on the left highlights for you the sharp collapse that we saw and subsequent strong rebound in secondary bid levels in just a matter of a 2 to 3 week span in the syndicated loan market in April and in May. A market that had nearly half of all loans trading at par in March saw a sharp fall to less than 4% of loans trading above par in April. Bids have since recovered, with now roughly 1 in 5 loans trading back at par or better. because investors basically came in, they seized on juicy buying opportunities amid a very slow deal backdrop. Even the tariff and recession sensitive sectors, such as autos and consumer, which fell to even greater depths in April to close to 95 average bid, have since recovered, although they're not yet to their full pre-tariff levels. Fund managers basically saw attractive buying opportunities at a discount, especially given the new issue market really didn't offer sufficient opportunities for deployment. The revived optimism over the past few weeks also fueled a jolt of capital coming back into the market. So high yield bond funds saw over 7 billion of inflows in the past 3 weeks, basically driving yields to tighten over 120 basis points back to the low 7% area from close to being 8.5% in April. And after 10 consecutive weeks of outflows from open-end mutual funds, flows turned modestly positive over the last 2 weeks. Moving to the next slide, we can talk about deal flow, which has perhaps been the biggest casualty of the tariff tantrum and the biggest complaint for lenders so far in 2025. Whenever there is volatility and uncertainty, it causes deal making to stall. And it takes a few weeks or even months to rev the M&A deal making machine back up. So before tariffs hit, 2025 was already underwhelming from a new money issuance perspective. And so the volatility that ensued was less than ideal for broader debt markets. Once a window of stability surfaced this month, sponsors and borrowers became very eager to take advantage of the improved sentiment and attractive financing conditions. So you can see in the chart on the left how much deal flow fell off in the institutional loan or the liquid loan market in April in the light blue chart. In fact, there were roughly 2 weeks in the institutional market where no deals came to market whatsoever. Fortunately, lenders and borrowers have found renewed confidence to transact, and the institutional pipeline is quickly improving in May, although clearly far below the 2Q levels that we saw at this time last year. Lenders are still showing caution in terms of deploying in some of the more cyclical sectors, so the market has not fully returned to the same level of risk-on sentiment that we saw earlier in the year. Now, direct lenders, on the other hand, showed far less variability in the deal volume levels. They continued to deploy in April, and you can see this in the chart on the right. The 2025 monthly figures, they're really not that far off from the same issuance levels we saw in 2024 monthly figures. Now, while pipelines did slow, direct lenders honored their commitments to sponsors, and they found that the volatility drove more deal flow their way. This is particularly true on larger deals, where the liquid loan market was simply not an option. I'll just mention a few names of deals that are already publicly announced or were covered by the media. Large-scale credits like Consumer Cellular or Dun & Bradstreet, which is a company that has been around for nearly 200 years. Jeppesen, which is a large carve-out from Boeing, and Walgreens pharmacy business. There are many others that have come to the direct lending market, but these are just a few examples of massive mega unis that went or are going direct, but are clearly large enough to get rated or to stay in the institutional market. And so this spate of bigger deals is a welcome relief, especially for some of the upper middle market managers that focus on large corporate borrowers. Direct lenders are hopeful that if the stability continues, that we could see a pickup in June and beyond. But again, caveating that volatility, hopefully stays muted. Flipping to the next slide, we can further drill into sentiment within the direct lending market. So as we know, most capital raised in the direct lending market is long-term, it's locked up, and it's sticky capital. The wealth channel has stayed the course and has continued to favor the asset class as flows have remained strong into perpetual evergreen BDCs and interval funds. While we only have the data through March, we expect that April and May will continue to show strong inflows, as many asset managers that have been on BDC earnings calls or in communication with their investors have signaled they've seen continued strong demand of inflows over the past few weeks. Why has demand stayed solid despite more volatile sentiment from investors in the public markets? So as direct lenders have had time to digest the news of the tariffs and do deep dives on their portfolios, they were able to very quickly communicate to their investors that really only 5 to 10% of their portfolios have meaningful first order exposures to tariffs. This is driven by a combination of middle market companies being largely domestic and having a predominantly US customer base. So this was really comforting for the space and for investors, rather than what you might see in the public bond or equity markets, where larger businesses tend to have more of a global approach to their business. Most of the tariff risk for direct lenders is driven by either supply chain or sourcing considerations, and it's really impacting just a few sectors, such as consumer, autos, retail, and industrials, which only really drive 15 to 20% of the CDLI. So moving to the next slide, we can talk a little bit about how pricing has been impacted over the past few weeks. So whenever there's volatility and recession fears, we all expect to see pricing and risk priced accordingly. However, pricing really has not moved very materially in either the public markets or the private markets. So looking at the public loan markets, once deal flow started to surface in May, there was some modest spread widening, as evidenced by the chart on the left, but now that market is turning back into tightening. Currently, single B rated loans are really only about 20 basis points wider than their pre-tariff levels, while higher quality double B rated loans in the institutional loan market are about 40 basis points wider. Unfortunately, the movement in direct lending spreads was even more muted. The direct lending market only saw the tougher deals move wider, while super high quality first lien loans stayed in the 475 to 500 basis point area. For direct lenders to see a bigger movement in spreads, there needs to be a sustained amount of volatility. And unfortunately, the liquid loan markets just recovered way too quickly for that to happen. The risk premium that direct lending enjoys over liquid loans in the chart on the right is around 160 basis points. So it's a little bit tighter than the 200 basis points that we saw earlier this year. That being said, it's really right where it needs to be. It's exactly in line with the 5-year average. So you are still getting paid to be in illiquid loans. Some market participants are saying they think the overall loan markets are maybe behaving too optimistic following weak GDP figures in the first quarter of 2025. And there's been a lot of front loading of purchases to build pre-tariff inventory in April. So we may not see the full effects of the tariffs until the second half of the year. Flipping to the next slide, we can show you data around how direct lenders are reacting to modest supply via spreads and structures. So what we all love about direct lending is its buy and hold nature. This drives direct lenders to underwrite higher quality credits that are capable of withstanding a recession. And so a lot of the riskier transactions are simply on hold in the direct lending market. And we actually did see a lot of deals get shelved post the tariff news and tantrums because private equity really just couldn't get there on those multiples on those tougher deals. So this year, direct lenders are exhibiting a flight to quality in their deployment behavior, where credits with very strong business profiles are highly sought after and are pricing very tight, while tougher deals are being shelved and are not being entertained in the market. Another interesting trend is the shift to Cov Light. So we've been getting a lot of questions on Cov Light. Is it okay? Why is it becoming more prevalent in the direct lending market? And the point that we argue often is it's the better quality credits that are of scale and size that are the ones getting Cov Light. And you can see this in these two charts, just looking at pricing. So in both the $40 to $100 million EBITDA range and the over $100 million EBITDA range, those are the candidates for Cov Light, you can see that the deals obtaining Cov Light structures are actually pricing 50 to 75 basis points tighter on spread than covenanted deals in the same EBITDA range. And so as direct lenders compete to win the best deals with the strongest business profiles at the larger end of the market, it is often the spread and the covenants that they cede on in exchange for deploying more dollars in a defensive company that they believe will cycle better and show minimal losses. And so pricing is really efficient in the direct lending market. There are no free lunches. Deals priced wider just tend to be riskier. Pivoting to credit health on the next slide, we can assess how portfolios are holding up. In the chart on the left, we track the trailing 4-quarter default rate within the CDLI. So Steve showed non-accrual rates. This tracks basically new loans that are defaulting each quarter over a trailing 4-quarter basis. And as you can see here, it's still relatively muted at sub 2%, matching Steve's commentary earlier. The default rate does benefit from the fact that there are a lot of big players that are out there raising money. They have fresher portfolios that are super clean. So We also can look at a few other metrics. And so in the chart on the right, we look at where watch lists are trending through time. When we assess the magnitude of managers that are placing loans on either their level 3 or level 4 watch lists, which basically includes loans they're either monitoring very closely or they view there's a risk of loss, we continue to see that it only drives about 8.5% of portfolios at fair value for the past 3 years within the CDLI. It's really not moving materially. And then in the orange line in the chart on the right, we graph for you what percentage of managers across the index are reporting an increase in their watch lists. And what gives us comfort is you're not seeing the watch list build in the past 2 to 3 quarters. If anything, the amount of managers that are adding names to the watch list the past few quarters has been declining. Roughly 30% of managers saw their watch list rise quarter over quarter at 1Q25. This actually compares pretty favorably to if you look back to the 2023 period, that's where we were seeing 40 to 60% of managers every quarter adding more deals to their watch list when base rates really started to shoot up and growth began slowing. And so, we're at 60 basis points of realized losses, which Steve showed earlier. A lot of those losses are being generated by the watch lists that were growing in 2023, and we're still not back to the 100 basis point loss rate. So I really like this chart on the right to signal where do we see upcoming losses 1 year in the future. Flipping to the next slide, we can drill even further into defaults. So there are a few sectors that are seeing degradation of credit health. And it's exactly the sectors you would expect. It's consumer, it's retail, it's media, because media is more advertising sensitive, which is discretionary spend for businesses, and then it's industrials. We've all seen the headlines from Target and Walmart about how shoppers are more price sensitive, they're buying less, they're shopping less. And so the consumer discretionary sector will be challenged, and tariffs continue to take hold in that sector. Meanwhile, industrial companies, their default rate historically was pretty low, but they do need to consider their supply chains and their sourcing models as they are facing increased costs on their imports related to tariffs. The good news is that if you look in the chart at the right, tech, healthcare, business services, and financial services are driving the bulk of the index composition. And all 4 of those sectors are actually showing declining default rates in 1Q25. Although it is important to note that the tech sector, which drives the bulk of the index, the default rate is a little bit elevated. It's at 2 to 2.5%. This is above its long-term average. Historically, tech was more in the 50 basis points to 1.5% default rate if we go back 10 years. So that is a bit elevated, and that is most likely driven by a lot of deals that were structured pre-2022, just had too much leverage when base rates went up from 0 up to over 4.5%. And then flipping to the last side, what assessment of direct lending credit health would be complete if we did not talk about PIK? Steve mentioned it earlier. But we know a lot of direct lenders now are offering PIK toggles, and they're more comfortable offering PIK out of the gate versus in historical periods. So this has made it very challenging for investors to assess credit health and determine, well, what's origination PIK and what's restructured PIK. So we try to do a little bit of digging for you. And what we did here is we went within the CDLI. We looked at all the term loans across the space that had a PIK component that was greater than 200 basis points in the rate. So it's not going to be PIK toggles that are turned off, but anything where the PIK rate is turned on, if it's over 200 basis points, there's likely some sort of liquidity stress in that borrower. So trying to understand how much of the universe is seeing liquidity pressures. The good news here is that we're not really seeing degradation. Back in 4Q23, roughly 11.5% of the direct lending loans there had a 200 basis point of PIK or more in the interest rate. And today that metric is actually slightly better at 10.5% of loans. So the good news is you're not seeing a higher share of loans flipping to PIK. And it makes sense because base rates have come down and spreads have come down. The bad news is that when we drill into the mark on the PIK loans within the CDLI, we are finding that more of the PIK loans are getting marked down each quarter. So back in 4Q23, roughly 20% of the PIK loans were marked below 95. And today that metric has risen to almost 30% of the PIK loans are marked below 95. When we look to see how many are marked below 90, back in 4Q23, 13% were marked below 90. And today that metric has risen to 20% are marked below 90. So Those loans that do have PIK, they are liquidity pressures, many of them, and we are seeing the marks on some of them degrade. So investors should continue to ask their direct lending partners, what percent of your book has PIK in it? And they should track the marks on those loans through time to see if it was truly at origination PIK or there are liquidity pressures. So we still think PIK is a good barometer of stress, particularly if you see the PIK rate is high on a loan that's not an ARR loan. To Steve's point earlier, tech, there's a good reason to have PIK on it because it's a high growth company. But if it's on a consumer company, if it's on an industrial company, you should be asking those questions. And most of the sponsors that receive PIK toggle optionality really aren't using it unless they need it. That concludes our prepared commentary. Steve, I'm going to turn the presentation back over to you to sign off.
Thanks, everybody, for joining us today. Please reach out if you have any questions. Hope you have a good start to your summer, and we'll talk to you next quarter. Thank you.